call it what you want: euphoria, fear of missing out, or just blind optimism. Today's market, as the Financial Times rightly called it, is the mother of all bubbles. Here's the problem. America's stock market has become so dominant that it's warping the global economy. Investors are throwing cash at overvalued tech giants, betting big on a US market that's already stretched thin. Meanwhile, Buffett's favorite warning signal, the Buffett indicator, is screaming danger, signaling levels not seen since the dot-com crash. So, what's really going on here? Why does Buffett believe this bubble is bigger, and potentially more dangerous, than anything we've seen before? And how is it about to burst? Today, I'm about to break down the numbers, unpack the risks, and show you Buffett's game plan for navigating what could be the most overhyped market in history. If you've been following financial headlines, you've probably noticed something. America is dominating the global financial scene. In fact, the US now accounts for about 70% of the global stock index, which is a pretty wild number when you stop and think about it. To put that into perspective, the US economy only makes up 27% of the world's GDP. That's a huge disconnect, and it's raising eyebrows among seasoned investors like Warren Buffett. Buffett's warning here is simple. The American stock market is overrepresented on the global stage, but how do we know it's overvalued? Well, there are a few key indicators to look at, one of which is the PE ratio, price-to-earnings ratio. This is a measure that compares the price of stocks to the earnings they generate. Historically, the higher the PE ratio, the more overvalued the market is. Right now, the US stock market's PE ratio is sitting relatively higher than at any time in history, except for the bubble before the 2008 financial crisis. Sounds familiar, right? And then there's the Buffett indicator, which is one of Warren Buffett's favorite measures to assess market health. This ratio compares the total market capitalization, basically the combined value of all US stocks, to US GDP. Normally, the market cap GDP ratio tends to hover around 80 to 90%. But right now, that number is over 200%, meaning US stocks are trading at historically high levels relative to the size of the economy. If that's not a flashing red warning light, I don't know what is. Now, let's take a step back and look at some historical comparisons. When we think about market bubbles, the first thing that usually comes to mind is the dot-com bubble of 2000. Back then, US stocks were incredibly overvalued, with tech companies like Amazon, eBay, and others being the hotcakes of the market. Investors were so hyped up about the internet revolution that they ignored fundamental valuations. Sound familiar? Today, we're seeing something similar in the AI and tech sectors, with companies like Nvidia and Microsoft soaring to insane valuations, all thanks to the hype around artificial intelligence. If you remember how things played out in 2000, you'll know that a market driven by speculation and overconfidence rarely ends well. Buffett has been cautiously optimistic about US markets for years, but even he knows the dangers of euphoria. He's repeatedly warned that overvaluation is a ticking time bomb, and when everyone starts to think the good times will never end, that's usually when they do. His thoughts on the dot-com era and the 2008 crisis are eerily similar to what he's saying now about today's US market. Buffett has often pointed out that markets can remain irrational longer than investors can remain solvent. The warning here? The market could continue to climb for a while, but it's likely running on fumes, and sooner or later, those who have been overexposed to high-risk stocks could get burned. To add to this, global investor behavior is playing a huge role in this market mania. As the US market rises, investors around the world are following the trend. We're seeing money flowing out of emerging markets and into the US, with global investors overexposed to American stocks, especially tech giants. It's become a self-fulfilling prophecy. As US markets climb, investors feel more confident, pushing prices even higher, despite the fact that they're already at unsustainable levels. Buffett's perspective on all of this is straightforward. Overvaluation and euphoria often lead to painful corrections. Be fearful when others are greedy. This is one of Buffett's most famous quotes, and it holds more weight than ever right now. As investors get more and more excited about the US stock market, especially the tech boom, it's easy to get swept up in optimism. But Buffett is telling us to slow down. He's been through these cycles before, and he knows exactly what comes next. painful corrections that shake out the weak hands. While the market is heating up, Buffett is playing it cool. Take a look at Berkshire Hathaway's recent actions. For starters, Buffett has been increasing Berkshire's cash reserves, just like he did before the 2008 financial crisis. This isn't a coincidence. When Buffett is loading up on cash, it's usually a sign that he's waiting for better opportunities, and most importantly, not trying to catch a falling knife. You might be wondering, why isn't Buffett jumping into the AI frenzy or the latest tech boom? It's because Buffett knows value over speculation is key in times of uncertainty. Instead of chasing the latest trends, Berkshire Hathaway has been focused on investing in undervalued companies, ones with solid fundamentals, consistent earnings, and reasonable valuations. Take his investments in Apple and Coca-Cola. These are companies with strong track records and clear, reliable growth. They're not in the business of chasing speculative bubbles. In fact, Buffett has consistently warned against buying into stocks that are overhyped, especially in sectors driven by speculation. During the dot-com bubble in the late 90s, Buffett was one of the few investors who refused to buy into the internet craze. He didn't care that everyone else was betting big on companies that had no profits or clear business models. He stuck with solid businesses like American Express and Geico, which were more predictable and had real, tangible value. Fast forward to the 2008 housing crisis, and Buffett's approach was similar. As real estate prices soared, so did the prices of financial institutions that were heavily exposed to the housing market. Buffett didn't get caught up in the subprime mortgage bubble. Instead, he made strategic investments in companies like Goldman Sachs and Wells Fargo, which he believed were fundamentally solid, despite the panic around them. When the dot-com bubble burst in 2000, many investors were left holding the bag on overvalued tech stocks, but Buffett saw through the hype. His advice back then? Don't get swept up in the euphoria. Be patient and stick to companies that have strong fundamentals. When the market corrected itself, those who followed Buffett's advice were much better off. Similarly, during the 2008 housing crash, Buffett told us to be cautious of financial institutions that were overexposed to risky housing assets. But the general market was caught in a panic-driven frenzy, and many people ended up losing big. Buffett's focusing on long-term value came out on top. So where does that leave us today? The market is in another euphoric phase, particularly in the tech and AI sectors, where stock prices are skyrocketing and investor sentiment is sky high. But as Buffett knows, when everyone's rushing in, it's often a sign that the market is due for a correction. The big question now is, what could burst this bubble? For Buffett, the answer is simple. The fundamentals don't add up. The market can't keep rising on sheer optimism alone. Eventually, investors will realize that prices have outpaced earnings, and when that happens, we could see a significant pullback. Let's look into some of the biggest risks that could pop this bubble. One of the biggest issues that could deflate the market is the mountain of U.S. debt. Right now, the U.S. is drowning in debt, and it's not just a short-term issue, it's a ticking time bomb. With debt levels surging to over $36 trillion and growing, the U.S. government is spending more than it earns. What does this mean for you and me? Well, when the debt continues to grow unchecked, it creates tighter fiscal conditions. The government will have to raise taxes or cut spending to bring the debt under control, both of which would slow down economic growth. But there's another problem at play here: interest rates. To combat inflation, the Federal Reserve has kept interest rates high for the past couple of years. Right now, it is somewhat stable, but still on the higher side. While this might seem like a good move to prevent runaway inflation, high interest rates are a huge drag on corporate earnings. When companies face higher borrowing costs, they might scale back on expansion or hiring. This translates into slower growth for the economy and, ultimately, lower stock prices. Buffett has been warning about this for years. He says unsustainable debt levels and prolonged high interest rates can eventually choke off economic growth. When companies can't borrow cheaply, they can't expand as quickly, which hurts stock prices and overall market sentiment. Now let's talk about the tech sector, because this is where a lot of the excitement and overvaluation is happening. Right now, investors are all in on tech companies like Nvidia, Apple, and Microsoft. These companies are great, don't get me wrong, but here's the thing. If these stocks fall, the entire market could take a big hit. Tech giants are just too dominant right now. Take Nvidia, for example. The stock has been on a massive run, driven by excitement over AI and semiconductors. But what happens when that excitement cools down, or when AI hype meets reality? If Nvidia's earnings fall short of expectations, it could drag the whole tech sector down with it. And because tech stocks make up such a huge portion of major indices like the S&P 500, a tech downturn could ripple through the entire market. Buffett, of course, has a different approach to investing in tech. While he has embraced companies like Apple, which has a strong consumer base and a predictable revenue model, he has always been wary of overpaying for tech stocks based on speculation. In fact, Buffett didn't jump into tech stocks until Apple showed it could deliver consistent cash flow and long-term value. He's always said that investing in tech is like trying to pick the next big thing in a game of roulette. The market can be volatile, and future growth is never guaranteed. But it's not just the US that would feel the impact of a market crash. The US stock market is a global behemoth, and what happens in the US doesn't stay here. If the bubble bursts and the US market crashes, it could have severe repercussions on global markets, particularly in emerging economies. Here's how. When the US market falls, global investors tend to pull their money out of riskier markets and funnel it into safe havens like US Treasury bonds or gold. But this leads to capital outflows from places like Brazil, India, and China, which could trigger a financial crisis in those countries. Emerging markets are more vulnerable to foreign investment flows, and when the US falters, these markets often see their currencies depreciate and inflation skyrockets. Back in the 2008 financial crisis, it wasn't just the US that took the hit. The global economy was pulled down with it. And if the US bubble bursts again, emerging markets are likely to suffer even more. Looking ahead, there's no clear sign of what will trigger the next downturn, but he believes that market overconfidence and excessive speculation are always the first signs of a bubble bursting, and right now we're seeing both of those things. The big question is, what's going to trigger the inevitable correction? Could it be a tech bubble popping, economic slowdown, or global financial turbulence? Only time will tell, but Buffett's warnings suggest that we're walking on very thin ice. Even though Buffett has been in a selling frenzy because of the overvalued market, last week he also bought some undervalued stocks for his portfolio. Click the video on screen to find out.